The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
To quote the late, great Alfred E. Newman, what? Me worry? Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Baston.
And I'm Alex Steele. I guess everyone's feeling pretty happy today.
Why not?
We're kicking you off to the closing bell right here in the U.S. So we're off the highs of the session, but nonetheless, we see a pretty strong rally underway, whether you're looking at tech, whether you're looking at the Dow, whether you're looking at the S&P. Now, tech, not the strongest performer of the day. That belongs to the S&P and the likes of, say, the Russell and the mid caps. But I did want to point out what is helping lead the rally, Romaine. You're going to get into it as well, but that's going to be AI. Look at the AI tech ETF, up a whopping 2%. Oracle up 7%. As we wait for some kind of announcement from President Trump about OpenAI, Oracle, and SoftBank, some kind of deal in that space.
Big tech getting a nice boost today, but we should point out this is a broad rally. In fact, the broadest that we've had in about 4 weeks, led not by big tech, but quite frankly, by big everything else. Among the biggest gainers today, power plant developer Vistra, warehouse Prologis, and vaccine maker Moderna. In fact, the latest fund manager survey out of Bank of America actually indicating that investors are seeing some opportunity right now, particularly as some of President Trump's most extreme policy proposals maybe get softened just a bit. But of course, if Trump 2.0 is anything like Trump 1.0, then you're going to have to stomach some of the volatility that goes along with it. We saw that with the tariff announcements earlier today that spared China for now, yet hit our North American allies, sending aluminum prices to their worst slide in 2 months and pushing the peso back near its weakest since 2022. Investors, from commodities traders to wealth managers, though, they say they're ready this time.
The last 24 hours are just showing that there's going to be a lot of changes that we all have to digest. At JP Morgan, we have a war room set up to analyze and evaluate each and every one of these. So they've been up all night and are working on it. And I think that, time will tell.
And that is the view from Davos, but adding to the pressure of a new Trump administration is back here in New York with the new earnings season kicking off, ramping up after the bell with reports from United Airlines, Capital One, and Netflix. Capital One trading at a record high, United at a record high, but Netflix, it might actually have some room to run. The stock, which dipped into correction territory last week, could see a 9% post-earnings move based on options pricing. Whether that move is up or down, Alex, though, of course, depends on what they say in just about an hour's time.
Yep, and that's the micro, but the macro is still what we're going to get out of Washington when it comes to tariffs. This is Bank of America's latest fund manager survey, obviously done before inauguration. Now, if you take into account targeted tariffs plus universal tariffs, 61% of respondents think we're going to get something along those lines within the first week of the Trump administration. Now, whether or not we do get it, all that is to say, Romaine, is that the street was prepped for it. If you don't get something, then you get that relief rally, and is that we wind up seeing today. Now, of course, we heard from President Trump in terms of Mexico and Canada. That could be February 1st. Maybe we're just prolonging then somewhat of the inevitable.
All right, well, who better than to kick off today's show this Monday afternoon, a focus on Wall Street, a focus on Washington and the intersection of the two. Stefan Selig joins us right now, founder and managing partner with Bridgepark Advisors, and also served in the Obama administration as Undersecretary for Commerce on International Trade. So a great person to talk to about tariffs that I think we thought were going to go away 4 years ago when Biden took office. He left them basically in place, and now Trump comes back and he's adding more tariffs, this time to a couple of our allies.
Well, maybe.
Maybe.
That's what he said last night. He also said yesterday morning that he was going to wait until a report was going to be issued on April 1st. And so, Romaine, I don't know. I mean, this could be, as has been much discussed, bluster negotiating tactics versus actual policy implementation. I think we'll have to wait and see.
How do you, as an investor, though, navigate this? I mean, we obviously had a taste of this for 4 years before. I think some people think this time is going to be different. Some people think it's going to be better. They say, yeah, he will be erratic, but there's sort of people around him this time around that will sort of make sure that the message is maybe a little bit more refined than what we saw during those first 4 years.
Well, there's the messaging, but there's also the fundamental use of tariffs, and are they going to be used in a nuanced, smart way? And so which economies are going to be targeted, how much those tariffs are going to be, what products they're going to cover. I mean, those are still big uncertainties. What I will say, if you listen to what his Treasury Secretary nominee has said about tariffs in his confirmation hearings, he understands both the power and the limitation and costs of tariffs.
So I'm assuming your phone's like ringing off the hook right now. Like, you got to have clients and companies calling you and be like, what do I do? Assuming that that company was alive back in 2018 or 2016, they've already done something. Where have companies been, and where do you tell them to go now?
Well, Alex, it really depends on what the product is, right?
Sure.
Because products have, first of all, not even the implementation, but products are going to be impacted differently by tariffs. If they're easily substitutable, then those products may in fact not be able to be sold in the United States. If they're not, what will happen is those products prices are just going to rise, and those costs are going to largely be borne by businesses and U.S. consumers. So it's not a one-size-fit-all response because it's not a one-size-fits-all impact for different companies.
How do you look at the sequencing them for your clients when it comes to tariffs to tax cuts? Because part of the rhetoric is if you get the tax cuts, even though you have the tariffs, we're going to even out and everything's going to be okay.
So this is one of the great misunderstandings about tariffs, right? Which is one of the things that the president and others talk about is the benefit of tariffs is the reshoring of American production, especially in manufacturing. They've also talked about, and the president talked about it yesterday, foreign countries paying money to the United States, to their treasury, to our treasury, to make up for potential tax cuts. You can't have it both ways, because in fact, if a company is paying the tariff or a person is paying the tariff, that is going into the treasury, but it definitionally means that good is not being produced in the United States. So it really is one or the other.
What about this whole tit for tat idea? I mean, we heard from Justin Trudeau in Canada, the outgoing Prime Minister of Canada, who basically talked about this could be dollar for dollar type retaliation. I'm not sure what Sheinbaum down in Mexico plans, but it doesn't seem like some of these nations are just going to sort of take it maybe in the way that they took it last time.
Well, look, history is pretty clear that any country that imposes tariffs, the response is almost always a countervailing tariff, and so we should expect to see that. And we saw that in the first go-around with China, where the president had to support U.S. farmers when China stopped buying soybeans. Yeah. And so, that should be an expectation. Yeah. And that is why some of this may be actually be negotiating posture versus actually a policy implementation.
Well, we're seeing some of that uncertainty show up in soybean prices today. Here's a question, might be a dumb question, but it's a question that I've been bothered by. If tariffs work, why is our trade deficit with China just as high, basically, as it has been for, I don't know, the last several years? I mean, the tariffs have been there. So what's the purpose of them other than just
they've been much more limited, Romaine, than what the president is talking about now. Yeah. But the reason with China is very specific, which is they are an export-driven economy, which means they are exporting more than they import. We are an import-driven economy because we're a consumer-led economy. Also, our dollar is fundamentally overvalued, which creates a problem for our exporting and a benefit for imports. And that is not going to change simply by the implementation of tariffs. Yeah. And moving a lot of this stuff out of China to be penalizing is, in fact, a possibility, but the likelihood of that all of that production gets reshored to the United States is actually quite unlikely. It's much more likely to go to Mexico or other, low-cost South Asian economies. And as a result, all of these benefits of tariffs, I think, get mushed up into one big pot, and all of them are not achievable.
You also have had decades of experience on Wall Street. So if you were to look at a sector that could actually do really well in this uncertain environment, what would that sector be?
Boy.
Deal-making, financials?
Deal-making, Alex, as you know, is never really helped by uncertainty. So businesses are really good about planning when they understand the rules of the road. And so my fear would be, despite all the animal spirits that seem to be being unlocked by the Trump presidency, that in fact, until some of these issues around tariffs get more clearly scoped out and defined, I think that will actually be a dampening on deal-making activity. That, combined with the fact that interest rates remain somewhat elevated, I think is not creating an ideal market for deals, despite the fact that I think what you're seeing in the stock market is, an enthusiasm for a much more pro-business environment from this administration than we saw in the last.
All right. Well, businesses, at least for right now, seem to be relatively encouraged by what they see. Stefan, we're going to catch up with you, I'm sure, quite a bit here as we start the new Trump administration, as we start our new show here on this Monday afternoon, counting you down to those closing bells, a dive deeper into the potential impacts of the newest presidential administration. This time, the impact on America's supply chain. A sit down with Brandon Daniel, CEO at the logistics company Exiger.
And plus, you got Netflix result out after the bell. We're going to break down what to expect, whether or not Beyonce and Mike Tyson were able to give the streamer a helping hand last quarter. Do you think we booked Beyonce for Netflix?
I was excited.
That would be awesome.
Okay, I guess I won't stick around. And when those earnings do hit the tape, we're going to give you the most important investor context, including a sit down with investor Ross Gerber over at Gerber Kawasaki. You don't want to miss that. Stick around. This is The Close on Bloomberg.
All right, stocks in the green across the board today, and it's a pretty widespread rally as well. Some say it's a relief rally after President Donald Trump didn't impose some harsh tariffs on day one. Joining us now, Callie Cox, Chief Market Strategist with Ritholtz Wealth Management. Hey, Callie, do you buy this kind of relief rally? Is that the right narrative today?
For now, Alex, and the reason why I say that is because earnings look stable, the economy looks okay, and all of this policy speculation was kind of on the rocks to begin with. So am I shocked that, it's day 2 of the new administration and we're not getting concrete tariff details, No, I'm not. But, a few months ago, we were also warning investors to be careful about, jumping into headlines too soon.
So do you need to hedge upside then? Like if you don't want to be buying the upside, you have to hedge it because we might get these kind of relief rallies?
Necessarily think so. And you have to remember, too, our clients over here are investing for years and decades. Mm-hmm. So higher stock prices are, something that obviously we welcome, Alex. And, we talk a lot about setting expectations over here. 20% rallies in a year in the S&P aren't something you should expect every year, especially when, the bar is a little bit higher this year. But overall, it's great news when the market is going up, and we think the market has more fuel to go up this year.
What is that fuel, Callie? Is this going to be fundamentally driven basically about the bottom line of what companies produce or something else?
Well, I think if you believe Wall Street, then yes, it will be fundamentally driven. And I don't look bottom up when it comes to profits, but those analysts who do look bottom up expect double-digit earnings growth in the S&P 500 this year. And, there are two ways to look at this, right? Of course, fundamentally, that's good news for the stock market. You want profits to be growing. You want the economy to be pushing forward. At the same time, we think expectations are a little bit too high. And the recipe you're looking for a good year, Romaine, is low expectations and pleasant surprises. We wonder a little bit if that factor of pleasant surprises is gone now because the bar is so high. But I don't think that's necessarily a reason to abandon the market. I think it's just another reason to look for balance in your portfolio.
I mean, it was kind of interesting. I was looking at the latest fund manager survey out by Bank of America. Obviously, these are bigger institutional type investors. But there was a lot of talk in that note that Michael Hartnett put out about this idea of looking at some of the laggards, of the market laggards, and that they could actually benefit in a way, particularly when you have so many of those big cap stocks that are either at or near record highs. Do you see opportunity in some of those lagging names, or is there a reason why they were lagging to begin with?
I definitely do, especially because the lack of breadth that we've seen this tech versus everything else rally over the past few years has been mainly due to interest rates. And of course, interest rates are still quite high, and the Fed indicated to us about a month ago that they may not come down as much as everybody thought about 6 months ago. But that's not necessarily a limiting picture for the rest of the market. Interest rates could come down. I don't expect the 10-year to stay around 4.5%. I think it should be a little bit lower. And as rates come down, it should allow the market to breathe a little bit, and it should encourage investors to look more at value stocks and stocks that were limited by high interest rates to begin with.
Right, Callie, is that a small cap value call, or is that going to be sort of a quality large cap value call?
Well, I think value is important right now, especially if you look at the market, you see valuations that are trending toward historical extremes. And I think you have to put a caveat beside that, Alex, because, of course, tech is trading at pretty high valuations, and then the rest of the market looks a little bit more reasonable. But right now, I think it is important to focus on value in your portfolio, especially if you're worried about what the future holds. I mean, the economy could be fine this year, but the fact that we're dealing with high expectations may mean that we see more of those 5 to 10% sell-offs, those inconsequential sell-offs that can kind of knock you off the base, knock you off of your own base for a few weeks. So if you want to shield yourself against those pullbacks, think about defensive stocks. But I actually think value is interesting here, especially those cheaper cyclical stocks when we have a lot of change going on in the economic outlook.
Yeah, and also if you still have money coming in for, say, infrastructure, particularly AI infrastructure, which we may get some announcement later on today. Before I let you go here, I got to ask about Bitcoin because you're talking about a portfolio construction, right? And talk about some whippy headlines, right? You get nothing at the inauguration address yesterday and Bitcoin goes down. Then you get the SEC acting chairman launches a crypto task force and crypto winds up going up, Bitcoin rallying. Does that need to be part of your portfolio construction?
I think what we've seen over the past few days with crypto really shows that you need to be smart about sizing things in your portfolio, right? We tell clients, crypto is obviously interesting. I don't think it's an asset class that you can quite ignore anymore, especially if you are a younger investor and you're more educated on what's going on in the space. It's an interesting space, but at the same time, it's a risky young market. And we've seen that in day-to-day moves in Bitcoin, one of the most well-known crypto assets in the space. And, the risk obviously gets a little bit higher from there. So size it appropriately. Remember that it is still a young, risky market, but there are a lot of developments in the space. And, if you're investing, I quite frankly don't blame you. Just know your risks.
All right, Callie, well said. Chief Market Strategist with Ritholtz Wealth Management, a day where we see stocks across the board in the green, led not by big tech, but by some of those cyclical names. The Russell up 1.8% on the day, twice the gain of the S&P 500. When we come back, we're going to focus in on another potential market-moving stock, and that is Netflix. From the Beyonce Bowl, she's not here, to Squid Games 2, also not here. We're going to talk about ending 2024 on a high note with its programming. We're going to preview what to expect from Netflix's earnings report. That comes after the bell. The preview comes after the break in our Top Call segment right here on The Close on Bloomberg. All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we start today with Apple, a rotten day for the maker of iPhones, hit with not one but two downgrades. Jefferies analyst Edison Lee, one of them, cutting his rating to underperform from hold, expecting Apple to miss estimates due to weak iPhone sales. Apple results out next week. Those shares at one point on an intraday basis having the worst day since August. Next up, an overweight rating from Morgan Stanley for the clothing and apparel company Urban Outfitters. The analyst touting Urban Outfitters' impressive success at incubating new growth brands. She also sees room for its valuation to expand as this year shapes up to be a stock-picking environment in softlines retail. Urban Outfitters up 10% here on the day at $60 a share. That's a record high. And finally, MoffettNathanson giving investors the green light to buy Warner Brothers Discovery. The analysts there expecting the media company to experience relative stability this year, driven by continued growth at its Max streaming service and reduced headwinds for that studio business. Those shares up about 4% on the day, best day in about a month. And those are some of our top calls. But we do want to stay in this world of streaming and entertainment because we're less than an hour away from Netflix. The company expected to post earnings after the bell, and much of the focus is expected to be on the push into live events and sports. Alicia, Reese is Vice President of Equity Research at Wedbush. She has an outperform rating on the shares, and she joins us right now. All right, let's start off with some of these live events, because that really seemed to be what investors were focused on, despite the fact that you had some glitches for some of those events. A lot of people did tune in for them, and I think the expectation is for the events they have planned going forward, that those numbers could be even bigger.
Yeah, there were some glitches in the fight night, but they were all resolved by the time we got to the NFL Christmas dual games, and we certainly don't expect any more going forward. Netflix has a good handle, I think, on what it's capable of and what it needs to do to accommodate the massive viewership that it can get globally for those live events. Whether it's domestic content, international content of any region, they can and are best positioned to show this content globally and get that that viewership going, and increasingly get some really great advertising going on those live events. They just announced the Women's World Cup, and I think that's the first of many more to come.
So, Alicia, when that earnings release comes out, the shareholders letter, everything else comes out later tonight after 4 p.m. East Coast time, what is the one thing that you're going to just really look for in that release above all and anything else?
Well, Netflix has been doing, I think, a good job of weaning us off of that subscriber growth guidance that they are not going to give anymore starting for 2025. So that includes the guidance they're giving going forward. But throughout 2024, they didn't really give specific subscriber guidance. They gave some, rough estimates, some guidelines, some brackets, if you will, on what to expect. And so instead, they're going to just focus on revenue guidance. And you have to kind of parse through. And I think they'll give some interesting language around what to expect in the first quarter and throughout 2025 with regard to what do we expect from the ad tier contribution to the ARM? What do we expect from, subscriber growth rates throughout the regions? I think they'll give enough color, but they got to hit that subscriber growth and that revenue targets and beat those, really. I think the bogey is 10 plus, even into 12, 13, really for the stock to really work for the fourth quarter. If they can show some really nice advertising growth and contribution into year end, I think that'll get the stock to work as well.
Alicia, in your universe, is there anyone who can come in a close second to Netflix at this point, particularly with their content pipeline that's coming up?
Absolutely not. Netflix has the cash to spend on content, whereas most of its competitors do not from their streaming services, at least. A lot of their streaming services are still trying to just get into the black and stay in the black and not bleed the rest of the company. For the other studios, though, they do have their theatrical segments that Netflix doesn't have to kind of keep them afloat, keep the cash churning. For Netflix, though, they're going to dig in a little bit on that too. They just announced theatrical release with IMAX. It's going to be, probably a pretty big deal for them, to get that theatrical revenue and probably the first of many. So I think they're expanding throughout advertising, throughout live events, throughout, potentially theatrical releases. They have a lot of opportunity to keep that really big lead that they have in terms of ability to spend on content and simultaneously generate lots of free cash flow.
Alicia, great stuff. Really appreciate it. Wonderful analysis. Alicia Reese over at Wedbush. She'll be very busy come 4 o'clock. But the stock is up almost 80% in the past year. It's not near its 52-week high, but nevertheless, it's still super solid. So again, it has to be that beat.
Yeah, and it's kind of, Netflix is so weird, right? Because it's like every quarter, I think we go through this sort of machinations of this the one that kind of knocks them off a peg. And, usually they post numbers that at least are good enough to keep going. And it gets to this idea, who are the dominant streamers right now? It is kind of Netflix, and I don't know, it's kind of everyone else. I mean, no disrespect to Warner Brothers Discovery. I love Max. You probably watch that more than Netflix, but it's not quite Netflix.
No, and not when you have the pipeline that Netflix is coming out for all their, Stranger Things, Wednesday. Anyway, coming up, Mexico and Canada. Yeah, I like that show. Are bracing for possible tariffs from the Trump administration. We're going to delve into the impact on supply chains.
He's a deal maker, right? And if you're a deal maker, the first thing you do is you show your powerful stance. So you make a broad statement, I'm going to tax Canada and Mexico by 25%. Well, and then you sit down at the table, you get them to the table, and you say, this is what I need. I need some help on immigration.
There's a lot of mutual interests between the U.S. and China, and we can work together. I think the benefit is much, much bigger than we fight to each other, become one winner, one loser. We even don't know who will win, who will lose, right? So it's a clear equation there. So I think President Trump understands that.
We obviously went through an inauguration and change of power in the United States yesterday. We know that's fairly positive for business. On the fundamental level, it's positive for business. It's a pro-business, it's a smart regulatory environment. So everyone's thinking that's very good for business.
All right, Gary Cohn and a lot of other folks chattering about the Trump presidency from the creme de la creme of the business world. Today marks the second day of the World Economic Forum out there in Davos, Switzerland. You are not in Davos, Switzerland.
I'm not in Davos, Switzerland.
All right, I don't know what time
I'm
it
here.
is.
with you.
All right, I don't know what time it is in Davos. It's 3:31 here in New York, though. And you are Alex Seal. I am Romaine Bostick.
So they tell us. You're looking at a definite powerful rally underway here. It was interesting to see the rhetoric in Davos this year versus, say, 2016. It's just a very different kind of Wall Street and global leaders confronting another Trump presidency.
And that was kind of the whole scuttlebutt coming in. It's like, what was this Davos going to look like? You know, you have a new president in the United States who clearly has kind of had an anti-globalist bent that was kind of the indicative of what Davos was. Yet he's also very pro-business, and he fancies himself that. So how do you sort of reconcile the two? Does Davos change or has Trump changed?
Right. Well, let's ask someone maybe on the ground. Brandon Daniels is CEO of Exiger, which helps businesses and supply chain manage all of those issues. He is also in Davos. You've been speaking, I'm sure, to many, many clients, CEOs, etc. What's the number one question you're getting right now?
The number one question is, what is the current trade warfare going to look like over the next 60, 90, 120 days? Everyone wants to understand what the major superpowers of the world are going to do to rebalance their economies and to rebalance the their global position against the complete landscape. So as you saw, early at the sort of end of last month, you saw where China rolled out export control bans on antimony and germanium and gallium. You're seeing the United States talk about major tariffs against China and Mexico. Everyone here at Davos is wondering about the potential business implications of this continued trade warfare between the two major consumers and innovators and business manufacturers of the world.
So the fact that we also have no idea how it's going to work out, what do you tell your clients about supply chain issues? I mean, if you haven't moved production or diversified production by now, what are you waiting for?
Yeah, I think there are three things to consider. Look, this isn't just about tariffs and about moving manufacturing back to the United States from a Trump administration policy perspective. I think there are really three things that, they're trying to accomplish. The first thing, and you can see this in sort of the pause as they start to evaluate the tariffs that they're going to actually execute. One, they want to make sure that they're putting tariffs against areas where the United States could have competitive advantage. There's not a huge difference between real estate in Peoria, Illinois, and real estate in, Hebei, China. And so the one thing is, where are there jobs where automation, where AI, where robotics can essentially neutralize the labor arbitrage between the two countries and put the United States in a competitive advantage. The second thing that they're looking at is, where do we have intellectual property that we want to keep? And so I'd imagine that these tariffs are going to continue to focus on the areas where we want to be competitive, whether that's in electrification of vehicles, or it's in quantum computing, or it's in advanced microchips and AI. And then the last thing I think you're going to see are areas where we want to make sure that how our U.S. companies are being treated by China is not different than the way that Chinese companies are being treated by China. Right now, you have a number of companies in the U.S. that can only source certain metals, certain components, certain materials from China. And they have a distinct advantage and huge economic advantages versus the United States companies that have to source them directly from China and have to pay tariffs against them, where China has sort of economic manipulation that can be employed.
I am curious, though, Brandon, because when we talk about the challenges on the supply chain, obviously it's not just about whatever percentage tariffs and where they go to. There are also some more sort of, I guess, practical or more sort of pedestrian issues that supply chain folks are going to have to deal with. And one of those is, quite frankly, are just trade routes. There's been, I don't know exactly what the president is talking about, but he seems to think that control over the Panama Canal should somehow revert back to the United States and out of Panama's control, whether that could ever happen. But I am curious that, do folks need to start thinking about these things as well, that sort of the traditional routes, the traditional sort of trade of physical barriers, if you will, could be shifted in a way that we haven't seen in decades?
Well, the thing, Romaine and Alex, there are a lot of issues with our existing logistics infrastructure, and we've seen it play out over and over and over again. Our ports are not resilient against many of the major storms and many of the major natural disasters that have happened. There are sweeping issues with labor. And obviously, then there's geopolitical tensions that erupt into chaos, like with the Houthis. And so I think what the administration is looking at is how do we relieve and resolve some of our contested logistics, which is one of the biggest problems that we have, is that our logistics are actually contested by adversaries or by new potential disruption types. And so, understanding what's going to be possible within our existing trade routes and what those relationships might be with, for instance, Panama, we're going to have to see how they evolve. I'm going to be meeting with the president of Panama here in Davos tomorrow as we're going through our meetings with world leaders and business leaders. And, one of the things I'm hoping to hear is how do we plan to improve the infrastructure, the economic relationships, so that we can actually continue to advance the mission that we have, which is to make the supply chains work again, which they have not been.
Yeah. We only have about 30 seconds, Brandon, but I am curious. The President of the United States is expected to address Davos as well, virtually, not physically. I am curious as to what you think leaders there want to hear out of him.
I think they want to hear that he's looking to do deals, right? I think they want to hear that this is not about a rigid set of hard lines. I think they want to hear that the United States is open for business, and that's the optimistic view. For the first time ever, there is a USA house here in Davos. There's always been an India house, there's always been a Brazil house, there's always been a Japan house. For the first time ever, we set up a USA house here, and that's because what we're hoping is we're coming to the rest of the world and saying, we're open for business, but it's going to be fair and it's going to be balanced.
All right, Brandon, really appreciate you taking time for us. Brandon Daniels out in Davos. He is the CEO of Exiger, a conversation about the supply chain issues that could arise here in the new Trump administration, a Trump administration that has wasted no time here in rolling back some of the previous administration's goals and targets. We should point out, just in he's not even been in office 48 hours. And he's done more than 24 executive orders. Just to put that in perspective, in his first time in office back in 2017, his first full week in office, he only signed 4 executive orders. Among the more than 24 executive orders that he has signed includes one that actually repeals President Biden's sweeping executive order regulating artificial intelligence. We want to go now down to Alondra Nelson, who formerly led the White House Office of Science and Technology Policy. She's now a distinguished senior fellow at the Center for American Progress. And she joins us now to talk a little bit about, I guess, the future of AI regulation and policy. Alondra, I am curious here as to sort of what comes next. You guys worked a long time on this policy. It comes out. There was a lot of talk here that if President Biden wasn't reelected, that this thing could potentially be toast. And as of today, it is toast. Is it over?
Well, I think it's a new beginning. I mean, listen, there were no surprises with the repeal of President Biden's October of 2023 AI executive order. Candidate Trump had it as a campaign promise that it was going to be something that would be repealed day one. So yesterday's repeal was not a surprise. I think what was surprising and disappointing is what is the plan going forward. So the Biden AI executive order has been talked about, I think, over the last 24 hours as being kind of very narrow and very regulatory, but it's also very forward-leaning with regards to innovation. So what happens to all of those investments? There were R&D investments to democratize AI. There was that executive order has stood up something called the National AI Research Resource that was championed by people like Fei-Fei Li, the prominent Stanford computer scientist. And that is making computational power, data, et cetera, available not only to academic researchers, but to startups. There were efforts here to really sort of diversify, democratize the sort of broader AI ecosystem, in addition to investing in talent, trying to, figure out how we're going to get our workforce right. Because if we're going to, win this race, this outcompete adversaries and competitors with regards to the AI race, we're going to have, compute, infrastructure, talent, and the like. And some of that's going to have to come from some of the commitments and investments that the Biden administration signaled, even if they come from the Trump administration, they're going to have to come from government.
Well, a big part of that executive order, the Biden executive order, was this idea of also making sure that a lot of the information that these AI companies are collecting, or at least sort of the outcome of the data they're collecting, was shared with the federal government. So at least there was some sense of knowing whether what was going on was right or wrong or damaging or beneficial. Is there any mechanism in place now without that executive order?
There's no mechanism in place. I mean, so it could be the case, Romaine, that that things will chug along and that the Trump administration won't stop things that are going forward. But you have to imagine, if you are working as an employee in the federal government, there's a little bit of confusion. So I think what was challenging about yesterday was not the repeal of the executive order. We knew that was going to happen, but it left a kind of lacuna, it left this kind of hole in the space of what happens next, right? And so does that mean that we continue to, have one of the world's few AI safety institutes, as we stood up at the National Institute for Standards and Technology that just had a great meeting in November that brought together the other safety institutes, UK, South Korea, Japan, and others, to be thinking with allies and partners about how you do this research well in a forward-leaning way and keep it safe. Does that go on or does that not go on? So I think there's just some confusion and a little bit of chaos with regards to the signals of what happens next.
Alondra, what about the states? Is it possible for the states to step in right now?
Sure. I mean, I think, but business is really worried about the state stepping in, which is why we really need this federal leadership. So I think the concern that we're hearing from, the business community is we're going to end up with a patchwork. If we don't have leadership at the federal level, we're going to have, as we do in Colorado, a Colorado state AI legislation. You've got, that Gavin Newsom, the governor of California, signed 18 bills in the last Congress, in the last legislature in California, related to AI in some capacity. So the state of Illinois, for example, has had sort of bills and laws on the books around AI and biometrics for years now. So things are already moving forward. And, we are going to need some federal leadership here, or you have companies dealing with the patchwork. And so, I think for businesses that are looking for some of clear direction, I think the lack of a replacement for what was repealed yesterday is a real challenge right now.
Alondra, what would you welcome from Washington? Like, what would be something that you could live with, considering that they don't want anything restricting AI?
Well, let's just be clear. I mean, a president's executive order has very few, it is not regulation formally for the most part. So it has very few kind of levers or kind of harnesses it can place on business. But what it can do is give shape to how government uses these technologies and how it procures these technologies, and also can make these investments in things that, business might not invest in: talent, workforce, research and development, particularly on potential use cases for AI that might be a market failure, that might not initially be things that you want to commercialize. And I think, what I would want to see in answer to your question is having government sort of help to build this ecosystem in a way that is trustworthy. So that was one of the words that was used in President Biden's executive order. Because right now, if you look at the survey data and the research, the American public is very, very uncomfortable with AI. So the Edelman Trust Barometer did some polling in the spring, and the United States has some of the highest mistrust measures with regards to AI in the developed world. Yeah. Like, we're in the top 3 or 4. Pew Research Center data shows that use is growing of AI across the board, but there's still a lot of concern and mistrust about whether or not it's going to be used in the workplace and how it's being used in the workplace, how it's being used in medicine and healthcare, and whether or not people are just going to get a fair shake.
Alondra, we appreciate that. We got to leave it there. Alondra Nelson, thank you so very much. Distinguished Senior Fellow, Center for American Progress, and former President Biden's Science and Tech Advisor. Great stuff. All right, 15 minutes to the closing bell on this pretty ebullient here Tuesday for the equity market. Katrina, I don't know, did I say it right?
Wow.
This is Bloomberg.
expect until some of these issues around tariffs get more clearly scoped out and defined, I think that will actually be a dampening on deal-making activity. That, combined with the fact that interest rates remain somewhat elevated, I think is not creating an ideal market for deals.
Stefan Selig over at Bridgepark kicked us off to the close here on this Tuesday afternoon. When I started the show, I said Monday afternoon.
You did?
I forgot Monday
I
was
didn't
a
even know that
holiday
you said
for
that. So that
MLK
says
Day.
things that are good for me.
Look at that, live on the air, corrections. And we talk about, though, the big rally that we had. Did you get your glasses, by the way?
No.
Oh, okay. All right. Well, I am observant in some other cases, and I did observe that the market had its best week last week, best week since basically the week of the election, and kind of resuming where it left off.
Yeah,
Nice glasses,
and small caps. Well, thanks so much.
Sure.
Small caps really leading the way there. I mean, look, we're up almost 2%. This is the best day that we've seen, the highest level since mid-December. So that rally most definitely broadening out, and it's obviously in some ways helped by tech. Interesting though that Apple is one of the laggards on that day. That's not helping going anywhere fast. But Oracle helping for the upside in tech.
Yeah, it was kind of interesting. A few of the Mag 7s are in the red today, including Microsoft and Tesla. So I guess people are looking for opportunities to buy, I guess, something else.
Sure, maybe we're broadening out. Will it continue? I mean, clearly the 200-day moving average is definitely solid for the Russell, but I mean, do we actually get a sustained breakout? That's continues to be my question.
That will be the question, of course. I will try to answer that here, maybe with our next guest. Katrina Dudley joins us right now here in Studio 2, portfolio manager and investment strategist with the Franklin Mutual Series. And Katrina, I mean, let's start off here kind of with the upside in this market, right? You have a lot of folks buying stocks today. They're not necessarily buying big tech in mass the way we would normally see in these rallies. They are looking at materials. They're looking at energy companies. They're looking at things that are much broader than maybe what we saw in the weeks past. Yeah. That's good, right?
It is good. And why? If we look at a 2-year forward EPS stack, all sectors of the economy are actually posting positive EPS growth. And that is what is driving the performance of the average stock, as we call it. So the 493 other stocks that make up the S&P 500. And earnings growth ultimately is what drives stock price performance. We can sit and talk about valuation. We can debate it here and there. And we do believe it's an important part. But if you don't see that earnings growth come through, you're not going to see stocks working.
Well, that gets to Alex's point about sustainability, at least when we talk about, small caps, mid caps, and the other, 493 in the S&P. Are we going to see that follow through? Meaning, are the corporate fundamentals going to be supportive of continuing to buy some of those laggards?
So it's always nice to just break things down into steps, and I like to do that with my kids. And so if you think about it, we have a resilient consumer. So let's start with that. A resilient consumer is spending more. And a higher spending in an economy that is 70% geared towards consumer spending is good for our GDP growth. And where are we seeing that? The Atlanta Fed just upped their expectations for U.S. growth from 2.7 to 3. And if we have stronger GDP growth, we have stronger earnings, and stronger earnings are good for equity. So it's just, if you kind of break it down into those component parts, it's actually a really good narrative to be bullish on U.S. equity.
I just had this image in my head. Instead of her reading bedtime stories to her kids, she's just explaining to them the ins and outs of the market.
How do you think I get my kid to go to sleep? I read her the research report that I'm reading. But then to that point, is that all things equal for small caps? Or are this going to be like large value cyclicals within the market instead?
No, I don't think it is that the large value cyclicals, because going back to that term, the value cyclicals, is really looking at the valuation versus the earnings expectations. And cyclicals are not particular, they're kind of middle of the road in terms of where we're looking at earnings expectations. Tech is still leading the way. Industrials are the second best in terms of our EPS expectations. But the valuations on the industrial stocks are not particularly inexpensive, particularly some of the really big brand names. So I think that you really just need to look at where and why companies are generating earnings growth. I think the parts of the market where we see the lowest rates of earnings growth are actually in the staples, which would kind of fit that defensive narrative, which is lower growth expectations and therefore lower room for upside on an equity basis.
So where's the juicy part?
I think it's really in looking at where the valuation and the earnings growth, there's just that mismatch.
Is there a sector where that works, or is it going to be one individual basis?
I think it's really, in this case, a little bit of one-off, because we have the positive narrative that I've talked about, but we also need to think about where are the risks in the market and what are the components of that risk. Tariffs is what we've talked about, okay? That's an easy part of the risk. Immigration is another part of the risk, but we're also seeing risks show up in healthcare sectors, for example, with changes in the Medicare. So you need to understand is what are the risks to the earnings and where do you want to be positioned, and then combine that with valuation. And I wish it would be so easy to kind of say go all in, but I think generally speaking, the breadth of the earnings growth expectations, such a broad swath of sectors, means that generally speaking, we think that the market as a whole can work.
We were talking earlier in this show here about the latest Bank of America Fund Manager Survey. Michael Hartnett making the case that some investors, U.S.-based investors, institutional investors, are looking outside the U.S. for better opportunities. Do you find a case to be made in any sort of broad, meaningful way to be invested, to allocate more, outside the U.S. than in the U.S.?
It's difficult because the valuation's cheap, but in my entire investing career, European markets have always been cheaper than the U.S. market, number one. Number two, this kind of earnings growth is not showing up in European companies to the same extent we see it showing up. One of the areas, though, we are overweight on Europe is actually in the bond market, because we think that the ECB is going to cut more. That will be good for the bond market. But the reason we think it's going to cut more is that we actually think they need to do more to support the economy. So they need to be that engine of economic growth. In the U.S., I think it's just the return of animal spirits that's driving our engine here.
Any worries about the dollar and the effect on corporate earnings?
I think that the strong dollar is pretty much baked into what people are expecting, so I'm not really worried about it. I don't think it's got a lot more further room to strengthen, but I think at these levels, it's kind of baked in.
All right, Katrina, always a great conversation. Katrina Dudley, she's portfolio manager and investment strategist with Franklin Mutual Series, helping us count you down to those closing bells. Just about 3 minutes away here on this Tuesday afternoon, Alex. And stocks are pretty much right where they were when we started. The S&P up almost 1%, but the outperformers, you're going to find that in the Russell 2000, the S&P mid-caps, and Dow Transports.
Yep, and also want to point out we get a lot of earnings coming out in the next 10 minutes' time. We get Netflix, we get Capital One, we get Interactive Brokers, and we get United. That's a nice swath. You're going to get a nice read on how the consumers are doing with both United as well as Capital One. Kind
of interesting to see the VIX subdued on this day. You're seeing a lot of buying in the Treasury space, actually pushing yields down. You took a look at commodities today?
I did.
Oil really down, but then, of course, a lot of the base metals dropped as well because of concerns about policies towards Mexico.
Yep, a lot of reports coming out about the ARB and then how you can trade the ARB between the two if we do get tariffs. And obviously for oil, drill, baby, drill, well, that's more oil and that's lower prices at the end of the day.
Absolutely here. So on this Tuesday here, of course, the first full day of the new Trump administration, the markets are taking it in stride, bidding stocks up, a lot of record highs out there, not necessarily on the headline indexes, but certainly on an individual basis as we break down all of today's market action right now with our global simulcast.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Alex Steele taking you through that closing bell, a global simulcast. It starts right now. The whole gang is here. Scarlet Fu wheeled into the TV studio. Carol Massar and Tim Stenovic in their radio cage as we welcome our audiences across all of our Bloomberg platforms. Carol Massar here on what looks to be a relatively phenomenal Tuesday for U.S. equity markets.
We call it home.
I know, and they don't let you out of it. Did you welcome Scarlet Fu back?
We love having Scarlet Fu.
Oh, yes, Scarlet.
The whole gang is here.
It's been so long.
Was she wheeled in?
I was literally wheeled in, yes, this is true.
Although her foot actually hurts, so that's not actually a funny joke today.
Oh, okay. All right, well, let's talk markets then. S&P 500, guys, most names. For every name that's down, roughly, you've got 4 names to the upside. So definitely a lot more of a broader upside trade today.
All right, I'm looking at Bitcoin because, yes, we did see a fresh record yesterday. The equity markets may have been closed due to the holiday, but ahead of Trump's inauguration, we saw Bitcoin hit 109,000 per Bitcoin. Now it's trading at just around 106,000.
It definitely feels like an everything rally, except for the dollar, which kind of stalled out. But you look at small caps in particular, 10 out of 11 groups are higher. That's kind of the same breakdown for the big caps. The only group that is lagging behind is energy right now.
Yeah, but taking a look at small caps, we're 8 points away from breaking that 50-day moving average. If we see some follow-through buying tomorrow, can we finally get that sort of sustained upside and a new level higher for small caps.
The broader market getting some big help today from NVIDIA, Amazon, Oracle, some of the big heavyweights. So the percentage gainers are definitely in that energy space, material space, as well as some of the industrial names as well. We are awaiting earnings out of a few companies, including Capital One, including Netflix, as well as United Airlines, as we get the closing bells in New York. Up 0.9% on the S&P 500 as Netflix, Carol, crosses the wire.
It does indeed. Netflix, let's go first of all to net paid streaming users in the fourth quarter, 18.91 million. That is a massive beat versus the estimate of 9.18 million. Also, the company getting into the outlook, it sees 2025 revenue, 43.5 billion to 44.5 billion. It had seen 43 to 44 billion. And you do see Netflix shares up about 5.5%, 7% here now in the aftermarket.
I'm looking at shares of United Airlines down about 1% in the after hours as we speak. Fourth quarter adjusted earnings per share did beat estimates, coming in at $3.26. Estimates were for $3.05. Fourth quarter operating revenue coming in at above estimates at $14.7 billion. Fourth quarter available seat miles also coming in above estimates at 78.3 billion. Fourth quarter revenue passenger miles exceeding expectations. Also shares right now just lower by about 0.7%.
I want to go back to Netflix for a bit because of that massive beat on the net paid streaming users in the fourth quarter, double what analysts had anticipated. In addition, revenue, $10.42 billion. That's the outlook for the first quarter, which is a bit shy of what analysts had anticipated, which is $10.48 billion. Nevertheless, you're seeing the stock really jump at the moment, up almost 8%. And Netflix has authorized an additional $15 billion in stock buybacks as well.
Yeah, I mean, it's really hard to find something super negative about this. Remember, this is the last quarter where we're going to be getting those subscription numbers. So it's sort of how do you then benchmark how well Netflix is doing in that revenue number? That'll do it for you on that high end, over $44.5 billion.
But why would you stop reporting your streaming ads if you're going to beat by double?
All right.
Good question. It's a good question.
You guys should take a closer look here at the investor letter here. The company does talk a lot about sort of the metrics that they will be using going forward, but more importantly, this idea of monetization and some of the efforts that they're making to do that. Also saying that they do plan to make a better, their words, push into games. They actually talk about some of the success they had with Squid Game Unleashed and how that could sort of be a template here for some of the other things. And of course, they talk a lot about live events here and the push there. So a company that is becoming a lot more layered in its offerings here, and at least based on what they're saying, they think that is going to be the future of this company. Interactive Brokers earnings are also out at the moment here. And sorry, I'm having a little trouble pulling it up. Here we go. Interactive Brokers is coming out right now. Those shares higher by about 1% here in the after hours trade after EPS did come in just a little bit higher than street estimates. Average customer margin loans also coming in above estimates. Customer accounts also coming in line at about 3.34 million. Net interest income at 807 million. Those shares up 1.2%, Carol.
All right, so let's also get to Massimo. It is, let me just pull it up here. Sorry, we're bouncing around here, guys. Actually, they've got a new CEO, and so forgive me, I actually don't have it up on my terminal. So they are announcing a new CEO at the company, so something that we're watching here also in the after hours.
All right, let's go take a look again, maybe at United. I just want to take a look at their guidance here, guys. The first quarter, if you're looking at an earnings beat, they're looking at 75 cents to $1.25 a share. That is a huge beat from what the expectations were. I was taking a look at that first quarter, doing quite well. Remember, Delta really set the bar quite high for United Airlines, and they delivered that fourth quarter profit well ahead of expectations.
I also, too, when we talk about this idea of consumer spending, the health of the economy, we were talking with Katrina Dudley just heading into the close. She was very optimistic, and a lot of that was this idea here that at least in the U.S. here, we continue to fire on all cylinders. GDP is up, consumer spending is up, and corporate fundamentals seem to be supportive of equity valuations, in her words.
Hey, I want to go back to Netflix because this is a blowout quarter, guys. Shares continuing to soar higher after the company reported net subscribers that was more than double what analysts thought they would. And I think it's this mix of programming, at least that's what the company is coming out and saying. I'm old enough to remember, I was talking about this earlier, old enough to remember when Netflix would never do anything live. Netflix would never do sports. Netflix would never do, like, a weekly talk show or something like that. Netflix wasn't even doing comedy specials a few years ago. This company is turning into essentially offering every mix of programming, and it looks like customers are paying for it. They're okay with it. I mean, I was telling Carol, I've never seen a boxing match in my life, but yes, I tuned into the Tyson-Paul match.
And you waited a long time to actually see that main event, too.
It wasn't starting, so I watched it the next day. I stayed off of social media and I watched it the next day.
And it's not just sports, too. I mean, we talk about the live comedy events that they've been doing. I know they had the one with Chris Rock and John Mulaney and a few others, and, of course, that roast of Tom Brady. So this is, not just sort of one thing. They really are experimenting with a lot. I guess the question is more, at least for me, making sure that the costs are under control and developing some of those projects.
And one way they can keep costs under control is to not bid for live sports. They do make the point that they're not focusing on acquiring rights to large regular season sports packages that does not include potentially things like playoff games or games on Christmas Day.
And this gets to the point, too, and probably to Tim's point, too, is this kind of does this kind of create the stickiness, if you will? Because we talked so much about the churn. Netflix, people will sign up for it just to see whatever binge watch the show, and then they leave. And now they have these various ad tiers, which are designed to keep people sticky.
Yeah.
And you have all these layered events here, which maybe you just kind of pay it and forget it.
Yeah, I do think, look, if you don't want to pay $20 a month for the ad-free version of Netflix, then maybe you say, okay, well, I'll go to that lower tier, the ad-supported tier. I can live with that because they're giving me a little bit of something that I want to watch at least every month.
All right, guys, I just want to get in here. Capital One, that company also reporting as well. So in terms of earnings, it was a beat coming in $3.09 a share. Total deposits also coming in quite strong, $362.71 billion. Net interest margin, though, was a little bit light compared to estimates coming in just above 7%. The net revenue coming in also a little bit light. They did talk about their fourth quarter having steady top-line growth in their domestic car business. They also talk about a return to loan growth in their auto business and stable credit card business, Carol.
Listen, I want to go back to Netflix, right? Because this is a big one, and we're seeing it move big time. Our Lucas Shaw weighing in and talking about this live programming and how vital it is to Netflix as it builds out its advertising business. So we're not going to get the subscriber numbers, right, going forward, but advertising is the way forward. And what's interesting, it says the company shows advertising during football and wrestling to all of its members, not just those on the less expensive advertising supported tier. He also says that in their 12 major markets, the majority of new customers opt for advertising in the 12 markets where it is available. So it just shows that people are, opting into that model, and that looks like that's the way forward when you look at where, kind of revenue growth is going to be going forward. So just kind of interesting stuff. All right, Netflix up about 10% here in the aftermarket. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it Beyond the Bell, closing bell. We'll see you again, same time, same place tomorrow.
And we continue our coverage right here on Bloomberg Television. The biggest mover in the after-hours trade is indeed Netflix. 18.91 million subscribers change, up about 44% year over year. And of course, the numbers that they really want you to pay attention to, those are the top and bottom line numbers. Revenue of $10.25 billion, up 16% year over year. EPS of $4.27. That's up from $2.11 year over year and above street estimates. And the guidance for the first quarter, the company says revenue coming in at about $10.42 billion. That's a little bit light from what the street was expecting, though not by much, 10.48 on average. And the company says it sees EPS of $5.58. Street was looking for $6.01, but you see the share reaction. Investors like what they heard. I wonder if our next guest likes what he heard. David Joyce joins us right now, senior analyst at Seaport Research Partners, who currently has a buy rating on shares of Netflix. You liking what you see, David?
Yes, and I'm glad that I upgraded it last week. The subscriber numbers, so the last quarter we're going to get them, but they really are really what blew away the expectations. The revenue came in line with our estimate, as did operating income and EPS. But what's more important is that the company increased the 2025 revenue guidance by about $500 million, both on the range that they provided in the prior quarter, and they increased their margin expectation to 29%, which had been at 28%. So I think that the momentum continues to favor Netflix. They're really doing everything right at this point.
They spent a lot of time in the investor letter talking about some of those live events. Now, they do make clear, David, that live events are still going to be a small percentage of the total programming, a small percentage of revenue. But to quote them specifically, they are saying that we think the eventized nature of these events will result in outsized value to both our members and our business. What do you make of that?
That has been their strategy since they started to dip their toe into sports. They didn't want to be buying full seasons. They just wanted to buy the more unique, assets that people were going to be tuning into more often than not. And that's what they continue to do with having a couple of NFL games on Christmas Day. They just won the rights to the Women's FIFA World Cup championships. And that's really where advertisers are really allocating their spending as well. So they don't have to, and this all indicates why they are able to increase their margins that are really at this point above the rest of their legacy peer group.
They also have room to increase their subscription rates as well, their plans, but they haven't announced that in this earnings announcement. A couple of analysts are looking for that to happen fairly soon because the last increase was back in 2022. When they do so, David, what kind of pop will that give revenue?
It really will be something that gets layered in by region and opportunistically as well. They could probably put in another 10 or 15% increase, something that's just on the cusp of retaining the customers, because you don't want to have to then spend to try to regain the customers if you lose any on price. But the other thing is that almost half of their gross additions are coming from this advertising tier, which are lower priced at the outset, but within 2 years should be generating a better monthly revenue than you get from just the subscription model. So I think that they still have a number of levers at their disposal. But I would expect that they just layer these in so they don't create a growth challenge for themselves. They want to continue to have things that people are going to be looking for to layer on in future periods.
One thing that they do point out is that there are some they felt a little bit of pain from the strong dollar. Given that the dollar is not expected to weaken anytime soon, it'll probably hold at these levels. Do you anticipate that to be not a risk, but a weakness here for Netflix? I mean, it can't do very much about it, but it's something to keep in mind.
It's something to keep in mind, but that fear of the FX did cause the shares to fall on nearly 10% in the recent weeks. And until last week, I thought that it was probably just getting a little bit out of whack, given the fundamental opportunity set that they have. Given that they're winning all these sports rights and generating subscriber additions and having the most nominations for the Golden Globes, they're really doing the right thing on the content side as well. Mm-hmm. And advertising is expected to more than double for them this year. So it really doesn't seem like the FX should be more than some noise. It's again, given that the dollar has strengthened so much, you're going to start to have some comparable quarters later this year where that change impact is not going to be really noticeable.
I am curious, though, David, when we talk longer term, because this is a company that really has found a way to kind of evolve with the times. One sort of aspect that I think it is, I won't say faltered on, but certainly hit a few speed bumps, and that was the rollout of gaming. They talk about this in the investor letter. They talk about Squid Game Unleashed and how that became one of the top sellers on the Apple App Store, at least among free games, and how they are going to take a little bit more of a targeted focus than maybe what they initially had laid out, basically focusing on really big names, big titles like Grand Theft Auto, like Squid Game, but also the idea of trying to be a little bit more platform agnostic, so not just for mobile, but something that could be played across all devices. Can this become a meaningful part of their business?
I think it'll remain something that's on the margin, but it is something that helps with the consumer engagement and retention. Helps to continue to brand some of their key pieces of intellectual property. It could be additive in time, but again, I think it will be more on the margin. This is This is really a more lean back kind of a model that they've done so well with just providing the content. So we don't expect the gaming to be that meaningful, but it'll be a contributor on the side. But it's I think has a lot of aura effects.
Right, but the bread and butter when it comes down to it is paid streaming users. And in the fourth quarter, Netflix added 18.9 million net paid streaming users. That is double what analysts had anticipated. Why stop breaking out this number? Why stop publishing this number?
Well, it's a law of large numbers. That means that they may not have such record increases again. I think they've really tapped into the bulk of their user base in the key markets around the globe, where they can be generating the really strong pricing growth and advertising revenue. So that's why I think with there being less of an upside on the subscribers from here, there are a lot of ways to continue monetizing them. But I think that would, while that metric would still be helpful, I think it's not the driver going forward. The driver going forward is monetizing this user base that they have in place. And given that their service already has very low churn, lowest churn by far of any of the streaming services, I wouldn't expect there to be a subscriber issue going forward. So we just really need to hone in on the advertising opportunity, the continued wins of the content, and what they might do on the ancillary side of things in terms of live experiences based on some of their IP as well as the games.
All right, David, really appreciate your joining us with your instant analysis. David Joyce is senior analyst at Seaport Research Partners. Netflix shares up by more than 10% in after-hours trade. We were talking about Netflix. We're also looking at United Air, its profit surging for the fourth quarter. And as a result, this, of course, remained on the heels of Delta saying that it sees a great year coming up. A lot of tailwinds for these legacy carriers. Yeah, and I mean, it looks like they're all sort of preparing for this idea that, of course, they are now getting at the capacity that is, at least for them, the best for their profitability. We even saw Southwest, which of course had been struggling for some time, scaling back a little bit here in terms of their employee count, particularly on the pilot side here. So when you look at the numbers out of United, when you look at what we heard out of American, at least with the big carriers here in the U.S., they seem to be doing well, Scarlet Fu. They seem to be doing well. There's a lot of demand for premium services, and there's a lot of corporate demand as well. We're going to continue with the earnings parade because coming up, we're sticking with Netflix and diving deeper into the world of streaming with Ross Gerber. He is CEO of Gerber, Kawasaki Wealth and Investment Management. This is The Close on Bloomberg.
Season is here.
The earnings palooza right here.
They're going to come in hot and heavy.
Bloomberg is first to break the numbers.
Microsoft earnings now crossing the wire.
Lam Research in the semiconductor space. AMD, Alphabet, we've got a lot to digest today.
With the smartest insights.
If the economy's strong, shouldn't that be good for earnings?
Consensus estimates are around 12% growth for the quarter.
Stick with us, a lot more coverage of all those earnings.
Continuing coverage on Bloomberg.
Welcome back to The Close. Romain Bostic here alongside Scarlet Fu. Netflix, Scarlet, the biggest gainer in the after-hours trade. And, well, why shouldn't it be? Another, well, encouraging quarter from the biggest streamer out there.
Yeah, and the number to look at here is 18.9 million subscribers in the fourth quarter. That was the net add of paid streaming subscribers. That is more than double what Wall Street expected, and it does top the previous best, which was an additional 15 million in the first quarter of 2020. Of course, that was during COVID when everyone signed up for Netflix. I know this is a number that Netflix says it will no longer report anymore and wants to shift everyone's attention to revenue numbers and operating margins, but it really opens your eyes.
Yeah, well, I think at this point, too, it's also about kind of retention. And I think they said it best in their investor letter. They had a whole section in there on monetization. How do you sort of make the most of the folks you have? Remember, this is a relatively mature company. It'll be interesting to hear what Ted Sarandos and Greg Peters, the co-CEOs, have to say on that, I should call it an interview, really. It's not really a conference call, but an interview that they have. I think that starts at 4:45 New York time, 1:45 out there on the West Coast. And it gets to this idea of what they want you to look at. So maybe they think when, as far as the future of this company, we should be focused on some of those dollar numbers rather than the actual subscriber numbers. Remains to be seen whether investors will go along with that, because I'm sure next quarter everyone will be like scratching their head like, why don't we have a subscriber number? Why don't we have a subscriber? Because I feel like everyone's just going to ask them for it anyway. So
they're going to model out their own versions of the number, right? Regardless.
Exactly.
Yeah, but you mentioned the events. It was a big live events quarter for the company, right? You had the Mike Tyson, Jake Paul fight. You had 2 NFL games on Christmas Day.
So
and of course,
have you watched any of these live events that they've done?
I didn't watch either of those, but I had heard that there was a lot of like the buffering issues. with the
it was definitely glitchy
match.
that they have to sort of work out. But I mean, the numbers were there in terms of the number of people that watch them, if you believe what Netflix told us. So it's this idea here that they basically become a network almost unto themselves to a certain extent, and they are able to attract eyeballs with these events. And we talked about this during the simulcast, the idea that they're not necessarily bidding to be like, CBS NFL or NBC or anything else. As long as they can get a couple games here and there, a couple events here and there, they seem to be content with that.
All right, joining us now to discuss more is Geetha Ranganathan of Bloomberg Intelligence. And Geetha, we're talking a lot about Netflix and how it feels like it's, the new cable TV operator here. It's becoming everything to everyone. It's got live events. It's got its original programming. It's got some sports. It doesn't want to become a regular sports provider, but it is bidding for certain special events. One thing that I noticed in the shareholder letter is Netflix saying, we believe we account for less than 10% of TV viewing in every country we operate. That suggests there's a lot more growth left here.
There definitely is a lot more growth, and it's really interesting that you bring up this whole live sports strategy. So I think so far what they've done, Scarlett, is they've taken a really measured, calculated approach, kind of seen how the programming resonates, with both U.S. audiences with the NFL and global audiences with Tyson and Paul. And I think they've got their answer. So now they really know that they can make much more, bigger bets in this, in this field. And again, it's also the mix. So they had this big splashy, events with the NFL, with the Tyson Paul match, and then you had them go after WWE, which is much more, consistent kind of year-round programming, right? Otherwise, usually with sports, you have seasons. Once the season ends, you have people kind of burning and churning. But with WWE and with the upcoming UFC rights, if Netflix decides to be a bidder, that kind of gives them that consistent, year-round programming, which viewers are going to come back to every week after week.
Where does the scripted programming fit into this, Geetha? I mean, they talked about it in the release, saying they understand the importance of having movies, having series that people want to watch. And that is kind of the core of what Netflix is, or at least how we view it. That commitment's still there?
That commitment absolutely there, Romaine. I mean, if you just look at the content pipeline for 2025, and they have said this many times on record, this is their strongest year of content. I mean, you just look at this slate. It is absolutely a blockbuster slate. They have returning seasons of all their hit shows, whether it's Night Agent, whether it's Stranger Things or Wednesday, or, even the new Knives Out movie. So it's all there. So scripted content, again, is going to be a huge driver for them in terms of subscriber ads, going into 2025. And then advertising becomes the bigger portion once you go into 2026. So they really have now this multi-year kind of growth strategy that's in place for, the company.
How much more detail are we going to get from the company when it comes to the advertising revenue? I mean, we know that Netflix says it expects to double advertising revenue in 2025, but it's been less detailed than investor would like when it comes down to, how many specific additions it adds to the ad-supported tier.
Yeah, they've given us, you're absolutely right. They've given us some, very spotty details, but we do know that they had around 70 million monthly active users. We don't know what that number was after, the Tyson Paul match or after the NFL games. So it's going to be interesting to see whether they provide an update there. But remember, 70 million monthly active users translates to roughly about 30 million ad-supported subscriptions. Again, they haven't told us anything about advertising revenue. revenue. And part of that is because advertising got off to a very, very slow start compared to what investors were expecting. That Microsoft partnership wasn't necessarily the best thing for them to kind of get their foot off the ground for advertising. But they're slowly kind of learning, they're unwinding. The biggest moves that they're going to make is really launch their own ad tech platform. And they're partnering with the biggest names in the business, whether it's Trade Desk, whether it's Magnite, whether it's Google DV360. So they're going to get this, this business up and running very quickly by 2026. And eventually, maybe they don't need any of those intermediaries and, they can kind of effectively keep all of those ad dollars to themselves. So that's going to be interesting to see. Yeah. But yes, you're right. Disclosure has been spotty.
Well, that's what I'm curious about, too. I mean, this is an intensely competitive business, something Netflix themselves points out. I was just taking a look at the share price reaction in some of its competitors, not seeing much of a bid at all, whether it's Warner Brothers, Paramount, Disney, et cetera. I am curious, when we do start to get earnings out of those names, Geetha, do you anticipate that we could see similar growth, or is this so specific to Netflix and the way that its co-CEOs are managing this company?
Somewhat specific to Netflix, Romain, although I would say that all the companies are making fairly decent strides in profitability, but they are ways off before they kind of get to this 30% operating margin. I mean, the 30% operating margin has been kind of that gold standard in media, and it's always been the question, can a streaming-only business ever kind of replicate the old TV playbook? And Netflix, with its guidance for 29% operating margin this year, has really shown that it can do it and maybe do it even better. Maybe even get to 35-40% operating margins. So it's going to be a long slog for all of the other companies. They're obviously not going to be able to get there, but they're still making, baby steps.
All right, Geetha Ranganathan over at Bloomberg Intelligence. Netflix up 13% right now in the after-hours trade. One stock that is benefiting from the momentum. Roku up about 4% in the after-hours. But the next big mover out there, it's an airline, United Airlines. Those results are out. A full breakdown of what we learned when we come back after the break, right here on The Close, right here on Bloomberg.
All right, we're looking at shares of Netflix up by double digits in after-hours trade after posting a record quarter, increasing their 2025 revenue outlook, adding to their share buyback plan, and of course also beating the pants off of their net ad subscribers number. Joining us now to discuss is Ross Gerber. Ross is co-founder, president, and CEO of Gerber, Kawasaki Wealth and Investment Management. Ross, thank you so much. It's a pleasure to speak with you. Talk a little bit about what impressed you the most when it comes to Netflix's results. I know that you were anticipating a strong quarter, and we did get that.
Yeah, honestly, it's sad they're not going to continue to announce subscriber numbers after they do 18 million in the quarter with a 10 million expectation. But, what it really is that the whole world wants to watch Netflix. It's the only international channel that wherever you are in the world, people can relate to. And now having sports events that transcend the U.S. market into a global audience, not only has it opened up new potential subscribers for Netflix, it's also made all the leagues reconsider their typical strategy of broadcast networks being the first people they sell to and realizing that companies like Netflix have a much bigger reach. And if you're trying to reach an international audience like the NFL, it makes a lot of sense to use this platform. So they've now proven that they can make money in advertising and on subs and globally, and this is unique to only Netflix.
It's unique, and I like how you put it, kind of how they become their own entity. They're like the new cable in a way.
It's global cable.
Right, global cable. But having said all that, they made clear in their shareholder letter that they're not focusing on acquiring rights to large regular season sports packages. When do you see that changing? It feels like a when, not if question.
I think it's not that as much as they have to make the economics make sense for them as they look at how much do we spend per hour per content, so if it costs them 10 million an hour or 20 million an hour, depending on the, different types of shows they're doing. So when you look at the NFL at 3.5 hours and you pay $100 million for a game, it's expensive content. But what Netflix was able to do, which I was surprised about, was they ran all the typical ads. The show was actually produced by CBS, which is basically the same broadcast just on Netflix, but they got all the same ad money to offset the cost of spending the $100 million. by then also making all their subscribers happy and getting new subscribers who want to watch sports. So it's a double win for them that they're able to, I'm paying for premium content, $20 a month, but I'm still watching ads if it's sports. So that's a win for Netflix.
I am curious, though, Ross, when we talk about, it's interesting to kind of see how the platform has evolved. With regards to the ad tier, or the different pricing tiers, I should say here, do you think Netflix would expand that? Or do you kind of just leave it where it is now with basically kind of the 3 tiers and just let people decide and then use your pricing power to adjust along the way?
Yeah, I'm more an In-N-Out burger kind of model for pricing, where keep it simple, give people, value and premium as options, but don't create overly complex structures. And so that's, I think, what they should continue to do. And they have, pricing power in that even on the highest level, you're paying $20 a month. And quite frankly, there are so few things of such great quality for $20 a month in anything that you do. So, it costs over $20 just to park in LA anywhere. So it seems like Netflix could raise prices for some time, as long as they do it gradually and not lose subscribers.
Oh, gosh, Ross, I don't even want to tell you what it costs to park out here in New York. But a good point.
I know, it's being generous at $20.
I know. I would take that. I am curious, though, in all seriousness, when we talk about also what gets on those tiers, I ran into something kind of strange. My wife and I, we were sitting down trying to find a movie to watch, and we found this movie, but it said, because we're on the lowest ad tier, the lowest tier, price tier, right, and it said that we couldn't watch it because of some licensing agreement that they had, I guess, with whoever made the movie, and that we would have to upgrade to the next one. That was the first time I've seen that. It was always like, basically any content you wanted was there. It was just a matter of whether you saw an ad before it or not. And I do wonder, are the studios or the people who, I guess, are licensing this content, are they playing ball with Netflix?
It's not that. It's the legacy contracts that they have with the studios that don't allow them to put all their content on the ad tier. Because, like, let's say I bought a show from Disney, let's say, and it's on Netflix, because a lot of Netflix content is actually owned by other competitors, which is interesting. But if I buy that show and I have the rights to play it on my regular tier, but now I'm throwing ads on top, but I'm not giving revenue to the original owner, that wasn't in the original contract. So some content still has those contract terms. Everything that Netflix is doing moving forward, hence the new sports agreements and everything, has this ad tier, and probably some sort of revenue share agreement with content creators. So, the way people are getting paid in Hollywood has changed dramatically. It started with the strike that was really predicated by the new model that Netflix created. But now as we move forward, the way entertainment, and not just Hollywood, music as well, the way it functions is much different than the model of the past. And I think Netflix is redefining how that is. And it's still in flux. And we're seeing that with Disney, ESPN. Like, I'm trying to watch ESPN on my app, and it's now telling me I can't do it, even though I have it on my Spectrum. And then I flip over to Spectrum, and I could watch the game ESPN on there. And I'm like, what is going on with ESPN? They have all these rights issues that will resolve itself in the next year or two.
Ross, I'd be remiss in not asking you. I mean, you are a California guy. I don't think you're coming to us live from your primary residence. I do have to ask you. No, I
can't live there right now.
I do have to ask you about the wildfires, and I know it's a touchy subject, but you are a California guy, and I know a lot of folks out there are really hurting right now. There's a lot of uncertainty about what comes next. I do want to just get your thoughts on the situation and what kind of hope you have for the future.
Well, unfortunately for me, I've been directly impacted. I'm not in my home, and I was able to save my home, fighting this fire myself, which I highly don't recommend. But I'm in a better situation than most of my friends and neighbors in our neighborhood was saved. But that said, my house is unlivable for the next several months. And it's created a tremendous impact on everybody in LA in one way or another, but especially Hollywood and the entertainment industry, because it was so affected, because Malibu burned down as well. So it's a really, trying time for people, and me included. But it's also, that's the way life is. We have to accept the risks of climate change and the way it's going to affect us all, and there's solutions for this.
All right, Ross, we'll leave it there. I appreciate you sharing that with us. We'll catch up with you again soon.
But my hopes and prayers are for all my friends and family and everybody who's been affected, that we can hold it together, keep your families together. That's the biggest thing. It's just trying to keep your family together. And it's a hard time for people, and it's happening. It happens all over the country and the world, and we all have to take note and make changes to our life if we want to sustain our lifestyles.
Ross Gerber, co-founder, president, and CEO of Gerber Kawasaki, and Los Angeles resident as well. we do want to kind of pick up on one of those last points that Ross did make here about Hollywood and, well, whether Hollywood actually gets back to business. Next week, Netflix is set to take part in a charity concert for victims of the LA wildfires. Apple, Amazon, Warner Brothers also going to be showing the event on their streaming service as well. Joining us right now is Elaine Low. She's a staff writer over at The Ankler, which covers everything Hollywood and what is supposed to be a busy time for Hollywood with the award seasons kicking off here. And Elaine, I do have to ask you about production. I know a lot of production was shut down because of the fires, even the areas that weren't necessarily directly impacted by it. What is the mood out there right now, particularly when there is talk of potentially getting back to work?
It's been an incredibly tough few weeks for this city, and it's been a particularly tough time for the entertainment industry, which has been through a very trying 5 years, starting with the pandemic in 2020, which shut down production for so many months, followed by this boom in television production that was quickly pulled back. We've all talked about the term peak TV, where there were about 600 scripted series on the air around 2022, and that quickly contracted as that bubble burst, reducing a lot of production in town, followed by the writer's strike and the actor's strike in 2023, which, again, there was no production for a great deal of that year. And last year in 24, even though the recovery was fairly slow in the first half of the year, as the crew members at IATSE were also going through their negotiations, as development was very slow to pick back up, there were some green shoots toward the end of last year, and that had people going into 2025 with some optimism, with some hopes that the town would be able to find a new cadence to figure out that new normal. And obviously that is not the case right now. But, in terms of production, there are some productions that have picked back up right now. But that's a real question as to, how the town is going to recover, because so many families were impacted.
What does award season even look like, particularly when we talk about some of the areas that burned? We do know that there are a lot of Hollywood celebrities who lived in those areas. Maybe they're not going to be in the mood to walk a red carpet to celebrate. I've heard with regards to the Grammys and the performances ahead of that, a lot of the parties around that have already been canceled in favor, of course, of this benefit concert.
Right. You're right. Premieres have been canceled. Studio staffers are largely working from home right now. When it comes to award season, the mood has really changed from, it being the regular celebration to what can we do to use these platforms to help those in need right now. And there's even been some discussion as to whether there should be an Oscars at all. And one point which some folks have made is, now isn't the right time to celebrate. But on the other hand, the Academy has said that there are some 1,000 people who are employed during the week of the Oscars telecast. So it's also part of the business of Hollywood where, that keeps a lot of people employed right around this time of year.
Yeah, I mean, I know the award season is big business for Hollywood locally, but production has largely moved on from the LA area. A lot of it is done outside of California, even outside the U.S., in cities like in Canada, where it's made to look like an American city. Talk a little bit about how the disruption of this wildfire might accelerate this push to production outside of California.
So an interesting figure that Film LA, which is the Los Angeles County's film office, released not that long ago, is that production for on-location shooting days actually declined from 2023 to 2024, which is remarkable when you consider that production was shut down for some 6 months during the double strikes in 23. So the fact that there was a 5.6 decline in on-location shooting days gives you an idea of the direction that production was going in, even though last year was a fully active year. So, I think with the number of cities outside of LA that are host to production, we've already seen an exodus of crew. We've already seen a lot of these productions move out of town. And there's no reason to believe that there might not be a similar cadence this year as well.
All right, Elaine, really appreciate your joining us today. Elaine Low is a staff writer at The Ankler, talking to us about how the wildfires in Los Angeles are going to impact Hollywood and production of our entertainment, both movies and television. Let's give you an update here on what's been happening over the last 40 minutes or so. We had a lot of companies report earnings. We've been talking about Netflix, of course. We also want to show you what's going on with Capital One. The shares are lower by 0.5%. Fourth quarter profit did increase due to widened net interest margins. There was also growth in credit card loans. And of course, this is a company that's in the process of trying to buy Discover. And given the new administration, Romaine, looks like it won't be opposed in that effort. United, a big gainer here, up 3.5% right now.
Yeah, we're going to have a fuller breakdown here of what we learned out of United. The airlines and travel continue to hold up, at least here in the U.S. Stick around. This is The Close on Bloomberg. Shares of United Airlines closed at a record high in the cash session earlier today, extending those gains in the after hours, up about 4%. This after reporting earnings. Operating revenue in the quarter up 8%. Passenger revenue up 7%. Cargo revenue up 30%. Other revenue up 12%, and the company guiding higher going forward. George Ferguson over at Bloomberg Intelligence joins us right now, our senior aerospace and airline analyst. And George, I don't know, maybe when we had this conversation, I think it was about American, maybe a week or so ago. What is going on with these airlines? I mean, they just continue to produce. They continue to outperform. What's happening?
And so I think you're going to see, though, I think you'll see a difference between the U.S. low-cost carriers than these full-service carriers that are coming through now. So United, really strong quarter, really based on their international business. You know, it's more not about Americans flying, but Americans flying out of the country. So strong dollar. We saw better yields, which, synonymous with price paid per mile flown, better yields across the Atlantic than Delta. United has a really strong international network, so it showed. And then we saw in the other regions of the world, which are smaller, Pacific, we saw United outperforming Delta, and into Latin America. Domestic yields were down 0.1%. Let's call them flat. Delta did a little bit better on that, but the domestic business looks, for premium seating, looks like it's okay. Definitely not near as robust as international. On the expense side, we saw higher labor costs than we expected, but lower fuel costs. But again, really a story about revenue.
Really a story about revenue, and it also is anticipating a profit for the January to March period, the first quarter. And the last time that happened was back in 2019. So the first quarterly profit in the January to March period since 2019. What is United doing to sustain this momentum in what is typically a weak period for not just United, but airlines at large?
Yeah, we've seen a number of these airlines are on the international networks. They're going out and searching for places where, Americans want to fly. We've seen United adding destinations in Africa, Northern Africa, Morocco, which are going to be pretty warm during that, this 1Q, right? So you could still attract some attention there. They're also rolling out coverage to the ski resorts and things like that. So really driving on this demand, this leisure demand. Remember too, like again, in the overseas business, the dollar is really strong. And so if you're in the U.S., the world looks like it's on sale. And I think United's network is really well positioned for grabbing a good portion of that demand, a large portion of that demand.
Yeah, and we're certainly seeing that reflected in the share price right now, up 3.6%. George Ferguson of Bloomberg Intelligence, thank you very much. We're going to stick with United and the legacy carriers and bring in now Thomas Black of Bloomberg Opinion. Thomas covers industrial and transportation sectors. And Thomas, you heard George talk a little bit about the discount carriers, the low-fare carriers, and kind of their struggles here. There's some talk that perhaps that business model of low-cost carriers is no longer viable. You disagree on that front, but say that they have a lot of work to do. That contrast between the discount carriers and the legacy carriers, why are discount carriers falling behind so rapidly right now?
Well, right now they're not offering a good product.
right? The legacy carriers are offering basic economy seats that are pretty comfortable, and then their airplanes arrive on time. That's a big factor. Whereas the low-cost carriers, especially in the U.S., their completion of flights and their on-time performance is toward the bottom of the barrel, so to speak. So that they not only have all these cut rate, items that they're offering you have to pay for water and this and that, you're not getting there on time. So it's not a good product. If they could improve those on-time performances, I believe there are people who want to save on airfare who don't necessarily want to hang out at a lounge at the airport and, might bring their own water or buy water once they're in the airport, right, from a vending machine, and they want to go on a cut rate budget. That audience is still out there.
Well, that's what I'm curious about too, Tom, because we talk about this idea of how some of these airlines, almost going back to the future, if you will, and kind of becoming commodities to a certain extent. Yeah. Talk about the ones that have done right. And we were speaking with George Ferguson earlier, and I misspoke. I said we last spoke about American Airlines, but that was Delta that had reported it was a week or so ago. And they knocked it out the park as well. And at least on paper, when you look at it from an investor's perspective, they've really outperformed in a lot of ways. This is a company that really did reinvest in its business, really did get its costs under control. But more importantly, Tom, they really made an effort to try to differentiate themselves from their competitors. We can quibble as to whether they actually did that or not, but there was effort there. And I'm wondering why we don't see more airlines try to replicate what Delta did, or maybe they are trying to do it and they just can't.
I agree. But this has been a long process. They've been investing in this product for decades or more, or a decade or more. So it is a long process to build out the facilities that have all these amenities and to be in that position. American Airlines is another one that is in a position to try to capture that customer that wants a better flying experience and hasn't so far. So it does have an opportunity there where Delta and United clearly are hitting on all cylinders, and the market is cooperating for them. Right now, we have travelers that do want to pay extra for that experience. I'm not sure that will always be the case. These trends come and go, but right now they are in the sweet spot.
All right. Tom, always a pleasure. Tom Black over at Bloomberg Opinion. A closer look here at those earnings that we just got out of United Airlines and, of course, maybe what the model might be going forward. Of course, that is one of the biggest movers, Scarlett, in after-hours trade. But the other big mover, of course, is Netflix. And more headlines coming out of what is now that earnings interview that the co-CEOs, Greg Peters and Ted Sarandos, are giving. First, they're saying that the wildfires in Los Angeles will, quote, have no meaningful impact on its content slate. The company also saying that live events only accounted for a minority of new customers.
Well, that just goes to show that they're doing what they're supposed to be doing, and the live events is just kind of the new talking point, the new narrative for the company going forward. There's a lot more to come on that front, whether it's sporting events or whether it's some big one-time thing that they do, like an NFL roast of one famous quarterback.
One famous quarterback, former quarterback. We should point out too, $9.85 a share. I'm just going to double check that. If this holds into the cash session tomorrow, I believe that is going to be a record high. If, double check my math there. And we talk about a 13% move coming into it. The options market was saying we were only going to get like an 8.5% move up or down, which was already outsized. So we're getting really outsized moves here in the after-hour trade.
Yeah, this is after the stock had fallen about 2% so far this month, so lagging behind its peers.
All right, stick with us. We're going to set you up for what to watch when we come back after the break. This is The Close on Bloomberg. A busy day on this holiday shortened week. It gets even busier tomorrow with earnings. J&J and P&G, a couple of the names reporting.
Yeah, J&J and P&G will be interesting because they both need to deal with the strong dollar. But Travelers is going to be the one I'm focused on because they're going to be quizzed about their exposure to the LA wildfires.
Absolutely. There, Alcoa Discover also on tap as well. Also in the morning, 7 a.m. tomorrow, we're going to get mortgage applications. Kind of interesting. We've actually seen mortgage rates go up recently.
Yes, absolutely. And what that means for how people are going to refinance or maybe they're or not going forward.
Our coverage from Davos continues, including an interview with Ukraine President Volodymyr Zelensky. You don't want to miss that as well. And stick around here. We are expecting to hear from the President of the United States, Donald Trump, set to announce more investments in the artificial intelligence space. Joe and Callie will have full coverage of that next.